All right. Welcome, everybody, to Finance Essentials with Danny Hudson. I am your host, Danny Hudson, and we are here for episode 31 on this wonderful rainy day. Well, it might not be raining where you live, but it's raining in Tennessee, and to the point where, garbage cans and stuff are getting washed away. But it's not so bad, right? We'll take it. We're here for an exciting episode number 31. That's the way I like it. Keep cranking them out. And of course, too, like we talked about in episode 30, right? Considering the type of show that we do, there's always tons of material. And this week, we're talking about a beautiful topic that everyone loves to talk about: capital gains taxes. I'm sure that's exactly what you want to listen to when you're listening to podcasts, is a podcast about capital gain taxes. But I swear, just like previous episodes, we'll make it fun, we'll learn some things, and I'm sure you'll probably get angry about some of the stuff that we end up talking about too. But hey, that's part of life, right? To get started, again, thank you everybody for being here, especially too for those of you that follow us on social media. I do have one request for you listeners out there. If you have the opportunity to, I know several episodes back we talked about moving away from advertising and marketing on social media platforms such as Facebook and so on and so forth, due to the fact that I don't really support the platforms as far as their practices go, as far as their involvement at a federal level, that type of thing. And so one of the things that I'm wanting to do is actually migrate the show to Odysee from YouTube. Probably run it parallel for a little while, and then we'll kind of go from there. But Odysee is essentially a YouTube, how it was described as a YouTube successor, right? So Odysee is built on a blockchain. It's similar to a very user-friendly platform, but the benefit of using Odysee on top of the blockchain is that it stores all of your content. And so if something was to happen and you wanted to move or you wanted to relocate off of the platform, you retain all of your followers, you retain all of your content, all of those types of things. And so to me, it seems, as a supporter of blockchain, as a supporter of cryptocurrencies, it seems like the only logical progression for me and for the show, and that's really the direction that I would like to go in. The problem is with Odysee is it requires a minimum of 300 subscribers on YouTube. So my mission over the next couple of weeks is really going to be able to push increasing up that subscriber count to where I can at least convert it over to Odysee. I don't necessarily need, obviously I would prefer it if people listened as well, but any help that you guys are able to provide as far as being able to boost up that subscriber count to get me up to that 300 threshold, so I can convert it over to Odysee, would be a huge help. And like I said, I'm going to do my best over the span of the next couple of weeks as well to get to that point that will allow me the freedom and the luxury of being able to move the platform off of YouTube, right? Which I think at this point, I think most people would like to do. But anyway, so on to the show. Well, I guess the easiest part to do actually would be if you go to YouTube and you search Finance Essentials, you should see it on there. Again, there's probably going to be about 30 videos. I think we're around 30 subscribers or so now, and I'll include a link in the show notes as well to the channel, so that way you can subscribe and then help me move away from the platform. But yeah, so a big favor from you guys this week, especially if you get some value out of the show, be able to help me promote it, get that subscriber count up, and then hopefully be able to move it off of YouTube. But so today's topic, like we talked about before, capital gains taxes, right? I'm sure a lot of you have probably seen, if you've been reading or following along with the news, that Mr. Joe Biden has decided that people who are what he calls the top wealthy people, he doesn't believe actually pay enough in capital gains taxes. And so we're going to talk about the reasoning of why he believes that, or at least why people are telling him to believe that, and what they intend to do, and then obviously what those potential ramifications are. So the source article was an article from CNBC, and it was called "How the Biden Capital Gains Tax Proposal Would Hit the Wealthy." So it starts off by saying, Joe Biden is expected to raise long-term capital gains taxes for the wealthiest Americans to 43.5%, including a surtax. That would be higher than the top federal tax rate on wage income. The tax rate would apply to returns on assets held in taxable accounts and sold after more than a year. Joe Biden is expected to propose doubling the tax rate on the wealthy Americans when they sell their stocks and other assets, again, increasing it up to 43.4%. Currently, investors pay 23.8% on long-term capital gains, and that includes a 20% capital gains tax and then also a 3.8% surtax, which was created with the Affordable Care Act, or Obamacare, to fund Medicare expansion. And so we know from listening to this show and following along and reading that I am absolutely sure, as you can also be sure, that 3.8% surtax for Medicaid and Medicare expansion is absolutely being spent wisely. No questions asked. But comparing it to the top income, tax bracket is only 37%. So that's why they're saying that this capital gains tax would essentially be the highest tax in relative versus income as well. A couple of caveats to it: the tax would only apply to those who make more than $1 million in annual income, and if again you've been following along, or you're very familiar with a lot of the people who are the wealthiest in the world, Mr. Jeff Bezos has an annual income of about $80,000, and so if I'm understanding this correctly, he would not be calculated into this. And then also too, Mr. Bill Gates is actually unemployed, right? I mean, he works for what, the Bill and Linda Gates Foundation. My guess is he probably doesn't accept a salary there. And so you can think about two of the top wealthiest people in the entire world. They don't actually would fall into this category. And as we've talked about in the past, there's always ends up being to government policy, right? And so in this example, the other caveat that I read is that there are possible exemptions, which is a certain portion of wealthy people and their capital, as well as business owners, or some element of business ownership. So, when I read that, it triggers my brain, and I'm thinking, okay, so the only people who are going to end up paying this are the people who are unaware that it's going on. And chances are, if you're making over $1 million a year in annual income, you're probably pretty aware that this is going on. Or two, you don't have the team or the staff of people that can help you understand exactly how this is supposed to work and how to avoid it. To give you a quick example of that, say I'm an executive and I'm making $1.5 million a year, right? And so theoretically, under this new capital gains taxes, I would be included in this, and then I would have to pay additional capital gains tax on my investments once I cash them out. New solution: now not only are you paying me, I'm going to start a business, right? It's going to be Danny Hudson Executive Leadership Inc. And so now, instead of you paying me $1.5 million, now you're going to be paying my business, right? You're going to be paying. And so essentially, we're going to have a team of accountants who are going to understand exactly what this means and help the people with the means be able to avoid it, and so they don't have to pay it. So that's the gist that I kind of got out of it as far as the CNBC article. Now, part of this is intended to pay for, which we'll get into a little bit later, a new spending bill that Joe Biden is intending to introduce. So in the past, we've talked about the infrastructure bill, we've talked about the stimulus bills, all of these kinds of things, right? This money is going to be allocated, or potentially allocated, for a new spending bill. Meanwhile, we're probably $6 to $8 trillion in the hole for the last year worth of whatever bills. And so I think it's interesting that they're talking about this new capital gains tax to pay for something that they haven't drafted yet. Meanwhile, we're, several trillions of dollars in the hole for things that they've already spent. So also too something to keep in the back of your mind. Now, the next thing that you're probably asking yourself is Danny, I've just listened to you blabber for 10 minutes, but I don't really know what capital gains are. So why should I be concerned about capital gains tax? And then obviously later on, we'll talk about, well, I'm not making more than $1 million, so why do I care? So to give you an idea, capital gains taxes are it's tax on the growth of investments, and it's incurred when those investments are sold. So to give you an idea, it's broken out into two categories, right? You have short-term capital gains tax and you have long-term capital gains tax. So short-term capital gains tax is going to be something that you purchase, an investment that you make, and then you sell it within a year, and that is actually taxed at your income level. So say your income tax bracket is 25%, you make an investment into Microsoft. Microsoft goes from $200 a share to $250 a share, and then you cash out 9 months later. You will pay capital gains tax on the gains that you did based off of your income tax bracket. Long-term capital gains taxes are items that are sold after a year. Right. So in that scenario, you buy Microsoft at 200, you sell it a year and a half later for 250. You would pay long-term capital gains taxes, which is the 23.8% on the earnings, the gains, right, that you made from buying and selling that stock. So that gives you a bit of an idea as far as where this tax is being applied, who it's being applied to, and kind of exactly what those capital gains are. And then obviously too, which, sometimes this is kind of related to me, but there's also capital gains losses, right? And so, for example, you kind of net out your losses and your gains, and then you would pay or not pay taxes based off of how your capital gains or your capital losses net out. So what's the big deal, right? Why is this such a big deal? Well, first off, obviously the Biden administration is playing defense, right? Because they're saying, well, it's only going to hit the richest 0.3%. And they're, like I mentioned before, their goal is to fund about $1.5 trillion spending package that is intended for education and childcare, which, as I say this, yes, you are correct. We will do an episode on breaking down this insane other 1.5 trillion spending bill. My guess is that they're looking at passing this because their infrastructure bill hasn't really gone anywhere, and at this point I feel like I kind of wasted an episode doing it, but hey, we all learned something there. But this one will be a separate package, another $1.5 trillion, and the estimates that I had read was that they're anticipating to through this new taxes gain about $370 billion over the next decade. Now, again, if you've listened to prior shows, you know a couple of things. One, they spaced it out over 10 years, right? Because that way, in 10 years, when they don't get close to $370 billion, they say, well, who could have known that we were only going to get $100 billion off of this? Because at the time when we set it all, this in place, this is how we were anticipating that we were going to be able to make this money, right? So all of the people who are in right now that make those types of decisions, they won't be around in 10 years, and so therefore we won't really be able to blame them. The second part of it is they're not going to get anywhere close to $370 billion. And part of it is because they've already talked about possible exceptions to people that this would fall into. And if you're talking about the top 3% of the people that are in this country, as far as your earners and all that kind of stuff go, they're not just going to sit around and let you take money from them. A perfect illustration of this, I think, is, well, I've got two of them, right? One of them is, if you've been paying attention to the House, House of Representatives allocation based off of the latest census data, California has lost representatives. New York has lost representatives. Michigan has lost representatives. Meanwhile, Florida, Texas, other kind of freer states, especially economically, have gained. So people are leaving these super expensive, these super taxing states. And if you live in California, and I don't know if New York falls into this, my guess is that they do, because they also love taxing people. But if you factor in state capital gains taxes, with this new bump up, places like California, you're going to pay more than 50% capital gains taxes on this money, which is crazy. Now, again, you're probably thinking, well, who cares? All these people make more than $1 million or whatever. But that's not the point. The point is that they're taking more than half of the money in capital gains taxes from these people. And so, again, what that's going to do is it's going to encourage people from these states to leave, which is what we have been seeing over, the past handful of years. I think a very good example to use this for is it's almost like Biden is having like a bake sale, right? They're going to spend $1.5 trillion and they're going to have a bake sale to try to cover it, right? I guess the only exception is that they're not actually going to bake. They're not going to bake anything to sell. What they're going to do is they're going to go to like the bakery down the street and then take all of their baked goods, and then they're going to come back and then they're going to sell them, and then that's how they're going to pay it. Or another example is if you've seen the movie Dodgeball, where the gym, Vince Vaughn's character, is about $50,000 in the hole for taxes and whatever. And so to raise the $50,000, they have a car wash, right? And so the thought there is that somehow in an afternoon, they're going to be able to have a car wash where they raise $50,000 to pay off this tax bill. It's just not going to happen, right? So really all this is it's a way of placating the masses, right? That says, we're going to take care of all of these evil rich people. And then on the flip side of it, what they're actually going to do is they're going to give all these rich people an out, to where the majority of them will not end up having to pay for it. Now, what's the drawback to this, right? As we will generally see with most legislation, something that they never really consider, which is unintended consequences. Because there's always going to be unintended consequences. Nothing is ever going to happen exactly the way that people intend for it to happen, because we're all going to react, right? We're all going to react to it. Say, for example, in this scenario, this rule applies to people who earn an annual income of $1 million, right? Well, guess what happens if I make $1 million a year and you're my employer and this goes into effect? Well, I'm going to make adjustments to IRA contributions, or I'm going to make adjustments to 401k contributions, or whatever it might be, to get my income down to $999,999. Or I might go to my boss and say, hey, look, my salary is $1 million. I want you to reduce it down to $995,000. And what that's actually going to do is it's actually going to save me money. So there's going to be unintended consequences, because whatever action they take, there's going to be a reaction. And of course, because of how slow moving and bureaucratic the government is, there's always going to be loopholes. There's always going to be ways around it. And the people are going to think faster and more nimbly than the government. Another perfect example of this is that recently the Biden administration talked about how they're looking at boosting the IRS funding by $80 billion, right? They're going to boost the IRS funding by $80 billion to go after rich people, right? They're going to give them $80 billion to recoup what? 5 billion? 10 billion? I mean, all of these rich people aren't going to sit there and go, yeah, no, I mean, I don't know what the deal is with my taxes. No, they have an army of accountants and lawyers who are going to sit there and go, yeah, bring it on. Why not? You guys haven't bothered us in a while. Let's go to court and battle it out. I'm already getting paid for it. Why not? And they're not going to get anything. My guess is that there's something that goes along with that, right? Whether that's $80 billion to, I don't know, call me paranoid or whatever, but my guess is that that would be an expansion to the IRS that would branch into some kind of green climate change bureaucracy that the IRS would oversee, right? Where they're going to be overseeing something to do with businesses or corporations or whoever that's related to green energy. Oh, and then surprisingly enough, look at that. We already have the funding for it, so we can already fund this department. I mean, obviously that's just speculation, but that's the kind of thing that I could foresee happening once they get that type of approval, because they're not going to collect that kind of money. I mean, to make it worth it, right, you'd have to collect, what, 80 billion, $500 million just to make it worth it? And let's be honest, it's just not going to happen. So what are the consequences here, right? The Financial Times put out an article that was titled, "Investors in Uproar Over Biden's Proposed Capital Gains Tax Rise." And again, I'm with you. I have very little sympathy for the majority of people that are on Wall Street, right? These guys, they're donating millions of dollars to campaigns. They're heavily swaying and being involved in legislation. They are actively working towards raising barriers of entry, reducing competition. So some of these guys will call themselves capitalists, but they are about as anti-free market as you can get, outside of government. So on a personal level, I have really no sympathy for these guys. But because it's important to stay consistent when it comes to our values, they also don't deserve to have this money taken from them, which I don't think is that much of a surprise regarding my position. So Anthony Scaramucci is the hedge fund manager or founder of Skybridge Capital, and he talks about, hey, this isn't about feeling sorry for us. Doubling it's going to have down the line impacts based off of job creation and wage growth for middle class. Another one investor, as far as Wall Street goes, also had talked about that it's shifting the model towards consumption rather than investment. And that I 100% agree with. And what that means is, and I believe it was Milton Friedman that talked about this, and it was in relation to inflation, right? Is that what this type of thing will do is it will drive people away. And when I say drive people, I generally mean, your investors, right, who are investing millions of dollars of capital into new businesses, whether it's tech or manufacturing or whatever, that doesn't really matter. But these are the people that would normally be investing in those types of businesses. And part of the reason that they do that is because they expect a return on their money, right? If you're starting up a business and I'm giving you $10 million because I think that it's a great business idea, chances are I'm probably not going to get a return on it this year, probably not going to get a return on it next year, might not even get a return on it for 3, 4, 5, 6 years. But when we do get that return and when we expect that return, that's why I would be making that investment. And so if you think about it from a capital gains tax perspective, 5 or 6 years from now, I'm going to essentially have to double the amount of return, right, that I would be able to get on that money to essentially get equivalent to the return that I would get on that right now. And the reason for that is because this bump that's basically doubling what the capital gains tax would be. And so if you think about it from an investment standpoint, now not only am I, going to pay double on the return that I would potentially get for this investment, but you can't even prove to me that your business will even still exist in 5 or 6 years. So the potential risk to reward when it comes to investment like that is just gotten that much worse, because now I'm putting in $10 million and I might not even get my $10 million back. I might not even get $2 million back, let alone an actual, solid return on by paying relatively low capital gains taxes versus income taxes or wherever else I might be able to put that money. So what happens, right? These guys, and as you should be concerned, as I am concerned, as we all should be concerned, is where do we get return on our money? And so if these guys are putting money into these startup companies and new businesses, investing and trying to get a return years down the line, well, they're going to say, well, that business isn't worth it anymore. The return that I could potentially get on that, the risk isn't worth it. So we talked about last episode, housing market, right? Over the course of the last 50 years, the housing inflation has outpaced standard inflation. And so what you'll probably find is you will probably find these guys, and again, something that you should also be concerned about too, is all of these guys finding ways of being able to diversify their money because they want yield, right? They want a return on their money, because holding money in fiat, which is the US dollar, is dangerous. It's dangerous because every year at this point, I don't think anybody argues against the existence of inflation. A lot of people don't necessarily understand or as concerned about it. A lot of times it's because they don't have any money. But these guys are concerned about those types of things, right? And so whether it's buying houses, whether it's buying land, whether it's buying raw materials, whether it's buying precious metals, I don't know. I don't have 10 million, 20 million, 30 million dollars. So I don't know where these guys and their business strategies and minds are going. But one thing that I do know is that a rich person buying his 14th and 15th house, that's not creating jobs. A rich guy, who's going out into Wyoming and buying 100,000 acres, that's not creating any jobs. That's not creating any wealth, right? Because there's no value creation in just parking your fiat in something that's not fiat. Him buying precious metals, I guess theoretically as precious metals increase, there's more jobs for people who mine it. And so I guess maybe there is some slight value creation there. But overall, all of this money that would have potentially gone into startup businesses would be rerouted to other places where people could expect a safer return on their money versus investing it into these potential riskier businesses that, again, may not even give them a return on their original investment. So that is the part when it comes to investors that I would be concerned about. Another article that I read that was really great, and it was from Brad Palumbo, who I've referenced quite a few times on this show, but he wrote an article on fee that was called Top Economists Just Warned Latest Biden Tax Hike Would Have One Huge Consequence for Small Businesses. And he kind of references the same points that we had talked about, right, regarding risky investments, new and innovative companies, and they're basically saying, the people that he had interviewed and talked to in his article, that these people who would normally be investing in these riskier type of businesses will not be doing so. He even mentioned that a lot of this money would potentially be going into safer investments like government bonds, which is I mean, maybe that's the plan, right? Maybe the plan is to actually get these guys into government bonds because no one wants to buy government bonds because the yield on those are pretty terrible too. But the concern there is that we wouldn't necessarily see a lot of businesses because the capital investment would not be there, and so why this is important to you is, and why it's valuable for you to understand this, is that when capital is not flowing into the marketplace, it's not flowing into markets regarding anything like investment, what you're going to find is you're going to find two things. Two, I guess, if you're watching, two, however you want to however you want to do two, but you're going to find two things, right? The first one is that there's going to be a slowdown of innovation and tech advancement because it's risky, right? That type of business venture is risky. But what you're also going to start to see is you're also going to see a rise in less riskier things. So things that we talked about before, housing, especially too, since I believe earlier today Jerome Powell came out and said that the Fed is not interested in increasing rates at this time. So rates are going to continue to stay relatively low. And so those are the two big things that you're going to potentially see due to this capital gains tax increase. And again, too, another thing that you're going to see is you're going to see that the government is not going to get, enough money to cover this $1.5 trillion package that they're talking about. So that's the show for today. I hope that you got some understanding as far as capital gains taxes go, and it's super important. Again, chances are you're probably not in the category of person that's involved in this, and therefore you might be able to dismiss it. But it's still very important because as we go along, and we are finding out that they're passing these stimulus packages and these infrastructure plans and these additional spending packages, right? All of this is going to have an impact on the long-term viability of the US dollar, of the US economy, of our livelihoods. And so if you're not thinking that and you're not factoring that into your considerations, whether it's long-term planning, whether it's diversification of your income, whether it's diversification of your assets and your investments, whatever it might be, those are the things that you need to be considering as this type of stuff is coming down. So think about it. I hope you got some value out of this. Like I said before, we're looking at switching off of YouTube. So if you can do me a favor, hop over to YouTube, subscribe to Finance Essentials. It would really mean a lot to me. I'm trying to get to that 300 target. And I think what I'm going to do is if we get to that 300, I actually have a surprise. I'm going to do a surprise giveaway to some very special listeners and subscribers to the show. And so that's going to be my next goal. Get to that 300 subscriber list. So if you get the chance, share the show with a friend, get them to subscribe. Even if they're not a big fan, it would be a good favor to me and I would greatly appreciate it. But we'll get there, right? We'll get that 300. We'll be able to get off of YouTube and we'll get switched over to Odyssey, which is something that I think would be a great project. But all right. Well, thanks for tuning in, and we'll talk to you next week. All right. Bye.